Okay, we're about two past the hour, so we'll go ahead and get started. And if a few more folks join in, they'll get caught up quickly. Before we do get to the main interview questions today, I did just want to give a little bit of background to who Cornerstone is. So many of you probably saw the emails coming to you, and it mentioned something about Cornerstone Wealth Management, Cornerstone Wealth Services. And I think it's always good just to really start off and give you some background on why you're getting this from this company that maybe you've never heard of before. And so to start with, Cornerstone is a registered investment advisor based in St. Louis, Missouri. We have 133 advisors scattered out through 15 states. We will be celebrating our 20-year anniversary this year. That's actually coming up in November, which is kind of exciting. And we're also so close to 10 billion in assets under management. If we get a few good days in the market, which hopefully that's what Allie's going to tell us about today, we'll see that AUM cross over 10 billion for the first time, which is very exciting. Now, one of the reasons why you may never have heard of Cornerstone before is because your advisor brands as something entirely differently from Cornerstone. And you can see many of the brands that you see on stage, or not on stage, but on the screen. You'll see Hummert Financial, you'll see LifeMap Wealth Management, you'll see Planify, you'll see Ginfinity Wealth Management. All of these great brands that we have are our advisors affiliated with Cornerstone who have decided to brand as something on their own. They've had that dream of launching their own firm, and we fully support that. All of our advisors happen to be affiliated with LPL Financial. That's the broker dealer. That's who custodies the assets. So you get statements in the mail from LPL. They also provide us with the product inventory for our clients. But I think the two most important numbers that you see on the screen are 29,000. They're the largest independent broker dealer in the country. And then also in the bottom right, you'll see zero. There are zero proprietary products that the advisors have to sell. So that means they can purely do what's in the best interest of you and really help you solve your financial needs without being pressured to sell an off-the-shelf or in-house type product. Now, how all this really comes together for you is you obviously have the relationship with your financial advisor. They choose to affiliate with Cornerstone because we give them some additional structure and scale in their business. We have best practices. We also maybe take some work off of their plate. This webinar would be a great example of that, where we do the planning, we book the speaker, we go through compliance, we get it to a point where all they have to do is send the invitation out. And then we also have LPL Financial, which gives us not only the custody of the assets, but the product inventory to really meet our clients' needs. And ultimately, what that comes down to is more time for the advisor to spend with you. And really, that's the main goal, obviously, of the advisors is to spend most of their time with you. Now, one housekeeping note before we do get started. If you do have questions, and we will open this up for Q&A at the end, you cannot use the chat function in Zoom. That's a compliance issue. We can't get past that. So the way you ask questions is you email them to Cornerstone WM, no dots, no spaces, no dashes. So Cornerstone WM at LPL.com. That will come to me. I will ask the question on your behalf. So let me stop sharing my screen and get to the main event, which is to introduce Allison Boxer. Allie is a senior vice president and economist with PIMCO. If you're not familiar with PIMCO, they're one of the largest bond managers in the country, and certainly have expertise in that area. But have products in equities. They have global equities, global bonds. Just about anything you can think of in any corner of the world they touch. So it's really, really a pleasure to have somebody from a firm like that who can give us some insights in terms of what they're seeing in the marketplace, and hopefully give us some clarity on all the headlines that we've had over the last few months. Allie's coming to us from PIMCO's New York office. She said she actually does have a great view of the New York skyline, but it actually happens to be reversed. So she's not sharing that with us, unfortunately, today. But she has an MBA from Wharton. She has an undergrad from Tufts, and she has been with PIMCO for over 11 years. So we're really excited to have you here today, Allie. Appreciate you joining us.
Yeah, well, let me just start by saying thank you so much, Bill, and to the whole Cornerstone team, not just for letting me come on tonight, but also, just for all of the partnership between our firms. Yeah, I unfortunately brought like the boring blue like conference room backdrop, and I think the lights are going to turn off on me at some point because they're on the timer too, so not nailing it. But I swear the New York skyline is in front of me. And of course, let me just say thank you to all of you as well. Getting your time in August, I know is special, so we really appreciate it.
No, thank you, Allie. And we know it's almost quitting time for you, so we'll definitely be mindful of your time as well. Really appreciate it. So, Allie, I have to tell you, so leading up to this, and in fact, just recently today, I'm hitting refresh on the CNBC website because there's a new headline seemingly every day. And I was trying to figure out, okay, where do we start? Do we start with tariffs? Do we start with the one big beautiful bill? Do we start with Trump firing Jerome Powell, or the person who's in charge of the jobs report, a lot of different directions, of course, that we could go. But I thought that maybe we would start with tariffs. And, the reason for that is it's a little bit more near term. We, of course, had the August 1st deadline last week. And, I wanted to ask you, we've seen some deals announced with some really large trading partners, Japan, the Eurozone. So where does this leave us with some of our bigger trading partners as we stand here today?
Yeah, it's certainly been an eventful summer, an eventful year. So as you mentioned, I've been at PIMCO now over 10 years. And I've been an economist through a pandemic, through various different shocks that have come along the way. And I think just given how frequent the trade headlines have been coming in, I actually think this is the period where we've been updating our growth and inflation forecasts for the US economy more frequently than any time I can remember in our career. So it's certainly been an eventful few months, for us as economists, for us as market participants. In terms of where we stand, I think what we've learned over the last several months is that it first seemed like 10% was the new sort of tariff rate, and now it's really looks like 15 is kind of the new 10. There's been a lot of different headlines. There's been announcements of deals. There's been sort of back and forth across the board. But overall, it looks to us like, if you average out all of the different deals and different things going on, that the US effective tariff rate right now looks around 15%. That's been sort of steady over the last, couple of months, even as we've seen deals come in. And I think this is really important because if you put that in context, we came into this year before President Trump was inaugurated with the effective tariff rate in the US a little bit below 3%. So tariff rates right now are about 5 times higher on average across the world than they were at the start of the year. And of course, if you remember, we came into this year with the tariffs that President Trump had put in place in his first term, still very much there. So pretty remarkable shift, relative to where we've been, not just over the last few years, not just relative to President Trump's, first term, but you really have to go back almost 100 years in U.S. history to see tariff rates quite this high. So pretty remarkable change. I think where we go from here, we're probably going to continue to see headlines. I think we can probably see more deals. We had the president of Switzerland in DC today. We're continuing to get these headlines. We think you can continue to see some deals. You can continue to see some headlines. But I think overall, the message that we should take away as economists and market participants is we're in a pretty new trade regime, and tariffs are likely to remain, several times higher than what we've been used to. And I think through this conversation, we'll get into some of the effects of what that, currently 5x where we started the year, tariff change could mean.
I'm really glad you used the word deals, and
Yeah.
we're certainly seeing it's not just this uniform tariff that we're seeing, but in some of the deals that are structured, it's the tariff, but then it's also a commitment of either the country or companies within that country to make investments in the United States. And depending on how you calculate it, you're talking about anywhere from like $5 to $14 trillion in new investments just in the last month. Could you maybe just talk about what these investments mean? So when a country or a company says, we're going to invest $500 billion in the United States in a new plant, what does that mean for the US economy? But then also, as you continue to see these things play out, ultimately, is that a good thing? Is that a bad thing? What does that really mean for the US economy?
Yeah, Bill, I think you hit on the main point, which is, the numbers that we're talking about when you start to add them together are really, really quite large. Each of the deals that the countries have been making and the companies have been announcing are quite different. So what Europe has agreed to is a little bit different than Japan and all of those things. I think there's some reasons to think that, some of these deals are maybe a little bit ambitious in scope, and we may not see, 100% of this get, happen, or it may play out over many years. But I think that the punchline is that even if you haircut these numbers a lot, even if you assume, okay, maybe not 100% of it's going to happen, or some of it was going to happen anyways, or all of those things, you're still talking about pretty significant, pretty big numbers. We'll see how long it takes to get shovels in the ground on all of this and how exactly it plays out. But I think, it's reasonable to assume that you can see, higher investment in the U.S., over the next several years, as a result of some of these things. So what does that mean? So investment actually shows up in GDP. So us economists, we obsess over, what's GDP growth going to be? Investment is actually a direct input into GDP. So we could see slightly higher GDP growth. Depending on the nature of some of these different investments, you could see it show up in other places, like maybe they'll involve hiring or construction spending if it's more like physical investment. A lot of what we've been seeing recently, and I think a lot of what we're likely to see over the next few years has been, sort of AI related investment. We're actually already seeing in GDP data, some of the tech companies have made really big investments. There's headlines about Apple again today with sort of, big tech announcements. We see that relatively quickly in the GDP data because these companies are going out and they're building data centers and they're buying computers and they're doing things that we actually account for in GDP. But I think the question from all of this investment is, how quickly and how significantly can it change, sort of more long-lasting issues about the economy? So things that we really care about, for example, is, can we see enough AI investment that the country becomes more productive, that we have higher productivity, that each worker can sort of produce more stuff than they did previously because, they've been given better computers and, sort of faster technology and AI tools and all of those things. And so, I think there's still a lot of questions out there. We've never really seen, trade deals of this kind before. We don't know how quickly or when exactly or how much of this investment is ultimately going to happen. But overall, higher investment, higher productivity, are things that should support growth and should support the economy over time, even if we're unsure on the exact timing and the exact magnitude.
You mentioned that we really haven't seen a regime, an economic regime like this for over 100 years with all these new tariffs being announced. And you could make the case that the Fed, through rate policy, has done a pretty good job as it pertains to bringing inflation down. I think a lot of people would feel like it's still too high in some areas, but it certainly has come down from the peaks of just a few years ago. Are tariffs inflationary? Do they potentially derail the progress that the Fed has made?
Yeah, so I have to preface this because I'm gonna give you like the most like nerdy economist answer to this question, but I do think
Awesome.
it's important. So like bear with me. So I'm gonna say that I think that tariffs raise prices, but I don't necessarily think that they raise inflation. So stick with me on that one. I do think that tariffs are raising prices, and I do think that they raise, to some extent, do raise prices. If you think about what happens in the U.S., if you're a consumer, a lot of what consumers, sort of at least right now, buy and shop and all of that does tend to be imported goods, especially in specific categories. Like we don't make a lot of apparel here in the US, just to give you an example. And so what happens is you have an importer who's, buying a product from a country that produces a lot more clothing than us. When they bring that product into the country, they are having to pay a tariff. And so some of what's happening is companies are paying for this, and some of it, what's happening is they're sort of raising prices and passing the cost on to consumers. So we are seeing prices in goods that we tend to import a lot of into the US. Again, apparel is the example I'm giving you, but there's other goods as well, electronics and those kinds of things. We are seeing prices go up a little bit. But to go back to actually answer your question, I do think it's important to draw a distinction between inflation, which is what the Fed cares about, and prices. And I know that sounds like such a silly thing, like prices are going up. Of course, inflation is going up. But I think the Fed really cares about not like what happens this month or next week or something like that. They really care about inflation being at their 2% target on a sustained long run basis. And tariffs should really be a one-time thing. they should really impact goods and not as much the broader basket of things that we consume, which includes services as well. So I do think inflation is going to go up a little bit in the short run. I think we're going to see goods prices continue to rise a little bit, nothing like we experienced during the pandemic, but somewhat higher inflation. But I think there's a really big difference between that sort of temporary thing. Us, again, economist nerds call this like a temporary adjustment in prices versus inflation, which means year after year after year, the rate of inflation is faster. Those are pretty different things. And the reason why I like make people suffer through this explanation of the difference between like prices going up temporarily versus persistently higher every year inflation is faster is because I think it really matters for the Fed. And so I think there's a scenario where it looks like, hey, wait a second, inflation looks higher. I'm paying higher prices for goods. Like what's going on here? But the Fed could actually still cut interest rates because it's been this more narrow, more temporary, sort of focus on goods. And the last thing I'll just say is, I think what we've learned over the last couple of months is that the inflation prints have actually been maybe a little bit softer than feared. We are getting this goods inflation. We are seeing prices go up. But overall inflation, the full basket of things that we consume, a lot of which are services here in the U.S., has actually looked a little bit more manageable. So yes, I do think tariffs are likely to make prices go up a little bit. Going back to where we started, again, tariff rates are like 5x what they were at the start of the year. This is it's a big shock. It's a big change in policy. But I don't, I worry that people hear tariffs, they hear inflation, and they think like, oh my gosh, pandemic, and the Fed hiked 500 basis points and all of that stuff. And I do think drawing that distinction between persistently higher inflation versus a one-time change in tariff rates is really important, which is why I make people suffer through like the economics definition and words like temporary price adjustment.
No, I appreciate you explaining that though, because that does really sum it up. It's kind of that one-time hit as opposed to that sustained just drubbing of higher and higher prices. So I want to move on to the one big beautiful bill. Speaking of new regimes, we obviously have some new things that have been put into that. Specifically the tax law that we have currently, or at least the tax code that we have currently being carried forward, being made permanent. But there are also a lot of other things that were in the one big beautiful bill, as you would expect to have in a big beautiful bill, a lot of other things. What are some of the most meaningful economic impacts that you see both short term and long term?
Yeah, absolutely. Yeah. So we've been calling it OB3 has been our abbreviation. I don't know if that's the technical term, but that's what we've been calling it. And I think exactly what you just mentioned, I actually would argue is the most important thing. And it's that certainty about tax rates not changing. So if you think back to President Trump's first term in office, we had the 2017 Tax Cuts and Jobs Act was the big Trump tax cuts that we got in his first term. Those saw pretty significant changes to the individual tax rates. And those were actually set to expire at the end of this year. So I think the biggest thing, and actually the biggest expense, if you look at sort of the scorecard of the cost of OB3, was actually that we have this certainty now that consumers aren't facing a big tax hike at the end of this year, that those things are now permanent, that we sort of know what the future looks like, and things are kind of staying in the status quo. So that was, I think, actually one of the most important things. Participants, we say like market participants, economic actors, people really like certainty. They like to know, okay, I can plan my life, I can plan my investment decisions because I know my tax rates aren't changing next year. So I actually think that's pretty important. And similarly, on the corporate side, we'd seen some provisions that help corporates, sort of have favorable tax treatment for investments that they make and R&D spending. So similar to the things we just talked about earlier with investments. We've seen those also get reinstated. So sort of back to where we were in 2018, we sort of have certainty that that's here to stay. And I do really think that that's important, even though people tend to focus on new taxes. I do think that's important. We also saw some new tax and spending cuts above and beyond what we'd seen. So we've seen some new tax cuts that will hit consumer bank accounts in the first part of next year. So things like no tax on tips, other campaign promises that President Trump had made, those should start to sort of make it into consumers' wallets in the first part of next year. So we think growth could actually reaccelerate a little bit. Spending could pick up a little bit at the beginning of next year because of those. And then, beyond next year, we do have some not insignificant spending cuts as well, to sort of help offset some of the costs of these tax cuts. So some cuts to things like Medicaid, changes to student loan programs that were sort of being subsidized by the government, those kinds of things as well. And so I think the sort of, if you piece this all together, I think sort of the three sort of, mechanisms, if you will, is one, we have this certainty, which I think is important, that the things are not changing. We're not going to see a tax hike. Number two, we have some, sort of a little bit smaller than 2017, but some additional tax cuts for consumers that are mostly going to hit in the beginning of next year. And then as you look to 2027 and beyond, we should see a little bit of, sort of a slowdown in growth because government spending will be a little bit slower on some of these spending cuts. So that's how I would summarize, again, what we're calling OB3.
So one of the criticisms that we've heard about OB3 is that it really didn't go far enough to deal with the debt and deficit situation. And you talked about some cuts in spending, which I numbers I've heard are like $1 trillion over 10 years, somewhere in that range, which is a lot of money. But when you have a $36 trillion debt, doesn't look quite as big. So where do we stand on the debt and deficit, and when does it really start to become a significant problem for the United States?
Yeah, so Bill, you started the conversation by saying, PIMCO is well known as, one of the largest bond investors in the world. So this is an issue that's, super, super important to us here, and that we spend a ton of time, thinking about and focusing on because, it's so important to the outlook for treasuries, which are, a big part of the investment universe in bonds. So this is like near and dear to our hearts. So I think there's sort of a bad news and then a, maybe slightly better news story here in terms of this. And I think the bad news is, we have to be sort of, we have to be honest with ourselves. I always like to quote Fed Chair Powell. He says every time he does congressional testimony, the US is not on a sustainable fiscal path. Budget deficits now look set to be roughly twice as big as they were pre-pandemic, sort of for the foreseeable future, now that we know, the path ahead because of OB3. And you cited some scary statistics in terms of how high debt to GDP already was in the US. And so I think this is, something we've been talking about for a long time. US debt to GDP was high 5 years ago, it was high 10 years ago. We've, had big budget deficits for a while. But we think, sort of this challenge is probably here to stay. We don't see any, sort of large bills or changes from here that are going to significantly change the fiscal outlook for relatively wide deficits. So all of that is like, the bad news. That's sort of the depressing part. I think the good news for us is that we do think that the US is a little bit special, and we still think that there are really attractive opportunities in fixed income, in treasury markets, even, being very honest with ourselves about this problem. So first of all, I do think the US is like a little bit special, and it has this privilege to be a little bit irresponsible because US treasuries are the reserve asset of the world. And that means that, sort of foreigners around the world, official central banks around the world, global investors, all have a significant allocation to US treasuries as part of their, their investment mandate. That means that when bad things happen, US treasuries tend to be sort of the asset that outperforms the sort of the diversifying asset in your portfolio because of this. We don't think that has changed. We don't expect that to change over the next 5 years. So we have that sort of special privilege to run deficits that are a little bit wider, to have higher debt to GDP, and sort of continue to have no problem sort of selling our debt. So that's good news number one. I think good news number two is the fact that we're talking about this on this call. I think it's pretty widely known at this point. I don't think any market participant is sort of, surprised by the stats that you just mentioned in terms of debt to GDP. We've already seen the rating agencies move on downgrading US debt. And I think what we've seen is that, even after that, interest rates have been relatively steady. Yes, we've seen interest rates move up when the Fed hiked, but we aren't seeing any signs of stress or problems. A lot of the bad news perhaps is actually in the price. And what we see when we have, sort of bad days, if you will. So think about Friday when we saw, downward revisions to employment data, some concerns about, oh man, how strong is the US economy? What you see is that flight to quality, that sort of diversifying aspect of treasuries still very much works. So long-winded way of saying, yes, we think there's a problem here that needs to be dealt with eventually. It's probably not going to be dealt with, anytime soon. We're still going to be talking about this if we do this again next year or in 2 years or in 3 years. But we still think there's, sort of a really interesting case to be invested in U.S. Treasuries, even despite this. And I think the price action we've seen in markets over the last, couple of months is very consistent with that.
Allie, all I can think about is I'm just happy that my kids have never used that they have the privilege to be irresponsible, although I'm expecting it now.
Yes, just the U.S. government, not anybody's children very much.
Okay.
I'll
Okay.
clarify that next time.
That's good. That's good. So I do want to talk about Federal Reserve policy and then potential for rate cuts. It's really hard not to start with the ongoing battle between Trump and Fed Chair Powell. Will he fire? Will he not fire? Can he fire? All of those questions are out there. So I guess I'll just start there. Do you think Powell's going to get fired, or do you think he'll serve out his full term?
So I would take the Powell serves out his full term. And the reason why we think that is, I don't think President Trump necessarily has a lot to gain by sort of removing Powell early, even though it's he's very much fond of sort of tweeting about it and making commentary, including going to the Fed in person. Gosh, what was that 2 weeks ago? Chair Powell's term ends in May of next year, so it's not really that far away. We have a Fed governor who just stepped down just last week, and she'll be out at the end of this week. So President Trump already has an additional seat on the board. There are already two Trump, sort of Fed governors who are in place from his prior, from his first term. So President Trump will have the opportunity to sort of, make more of an impression and sort of remake the Fed. Over time anyways, as is typical in any administration. So we don't think, he necessarily gains a ton by getting rid of Chair Powell. We know from a markets perspective, markets really value an independent Fed. And there's been some concern around, sort of signs of President Trump interfering. I think firing Chair Powell would be a strong sign of that. And so, I think the question we sort of ask ourselves is, he gets to pick his Fed chair relatively soon. He gets to have him in place. President Trump gets to have him in place next May. So maybe not a ton to gain. Certainly, we don't have an edge on predicting perfectly, what the president is going to do. But I think the message is clearly we'll have a President Trump, sort of chosen Fed chair from May of next year, and that's I think where more of the focus is.
So markets do seem to be pricing in rate cuts later this year, perhaps at the September meeting. And maybe the surprise of the bad jobs report that came out last week with the revisions would be one of those conditions that would need to have to start showing itself to lead to the Fed actually beginning to cut rates. So, question I guess is, what other signs do you think would need to be there for the Fed to start cutting rates? But then also realistically, how many cuts do you expect over the next 12 months?
Yeah. So the Fed has this dual mandate of stable prices, which means inflation. They target 2% inflation, and then maximum employment, which is like a little bit more ambiguous, but generally means labor market looking healthy across a lot of different metrics. So low unemployment, hiring solid, all of those different things. And I think the challenge that the Fed is facing right now is we just talked about, prices going up, sort of some temporary inflation because of tariffs. But at the same time, we just talked about the fact that we've seen a softening of the labor market. Hiring has slowed, the unemployment rates come up a little bit. So you sort of have that dual mandate kind of like moving in tension. And so I think for the Fed, the message right now is sort of like risk management is kind of their best policy. Yes, the labor market's slowing, but it doesn't look terrible. Yes, inflation is going up, but it sort of looks like it's mostly a goods problem. All these more temporary factors. And so we think the message for the Fed is that given there's some risks kind of in both directions here, it makes sense for them to get interest rates back to sort of a more normal or what we call a more neutral policy setting. So when the Fed meets, they publish actually forecasts of where they think interest rates are going to go. And one of the things that they actually publish is sort of in the long run, in kind of a steady state, where do they think interest rates should be? They think that's about 3%. Some of them think it's a little higher. Some of them think it's a little bit lower. But we think it makes sense for them to be sort of slowly, gradually, bringing interest rates back towards that sort of more normal, steady state over time. So we actually do think that they could start to cut interest rates again in September because it does look like, going back to that dual mandate, it looks like the employment side of that is maybe a little bit more at risk because hiring, we just learned on Friday that hiring has slowed. And we think overall in sort of a base case, We think they're going to sort of try to get interest rates back to that sort of like, 3%, maybe a little higher than 3% over the next, call it, year and a half. So just sort of gradually cutting interest rates back to a more steady state. If we're wrong and inflation is much higher than what I talked about, and we see a broadening of inflation, it's not just a tariff thing, they can stop, they can pause and just keep rates on hold. If the next jobs report is even worse and they're more worried about the labor market, they can cut a little bit faster than what we talked about. And I think those are kind of the two levers to be focused on. So mark your calendars for payroll Fridays and CPI releases, CPI inflation. Those are like the two big ones for the Fed to be watching.
So, Allie, if all the things that we talked about so far weren't enough, I guess we could also throw in some geopolitical risks as well. So, we continue to have the war in Ukraine with Russia and Ukraine. We have obviously the ongoing conflict in Gaza. There's seems to be a lot of hot spots around the globe. Throw in with that maybe some potential trade wars with tariffs and other things. What are some of the biggest geopolitical risks that you see over the next 6 to 12 months?
Yeah, it sort of goes back to where we started of like, man, it's not been a quiet summer. It's not been a quiet several years kind of on all fronts. Yeah, I think you just mentioned sort of the largest geopolitical hotspots. And obviously, pretty sad humanitarian situations whenever we have wars. I think in terms of markets though, I think there are obviously like very specific, sort of, maybe slightly more niche asset classes that are very much affected by this, and sentiment and investment and trade can certainly be affected by conflicts as well. But I think what we've seen is that, it has tended to be slightly more of a micro issue than a macro issue for markets. And so what I mean by that is, we've had big energy price shocks from some of this. We've seen, sort of specific countries be significantly impacted and shipping disrupted and all of those things. But in aggregate, the U.S. economy has performed pretty well despite, some of these scary headlines that are sort of looming out there. In aggregate, asset price returns have been pretty strong over the last few years. And so I'm certainly not a geopolitical expert. I'm very spoiled here at PIMCO in that we have lots of geopolitical experts who are sort of, available to us, who are regular advisors, who come into our investment committee, who warn us about these risks and help us better understand what's going on. But I sort of take the view that for like general, sort of general investment, unless we see a much, sort of broader sort of, set of geopolitical spillovers, that from a markets perspective, the U.S. economy is pretty resilient, and it has been sort of able to weather some of these shocks.
Let's maybe move on from economics, geopolitics, and we'll talk about just markets, and we'll start with the stock market.
Yeah.
And obviously, I'm going to just ask you a question about market leadership, and to frame that for everybody on the call listening in, if you've had any exposure, even if you were buying an S&P 500 fund and you had exposure to the mega cap stock, mega cap tech companies, the Mag 7, anything that's related to AI, you've had massive returns in your portfolio over the last 2 years, really, at this point, maybe even longer than that. So that's great, but it also means that you've had very, very narrow leadership in the market. It's kind of been that and then everything else. So is that narrow leadership, is that risk in the market, or is it just a healthy sign of innovation?
Yeah, it's a great question. So I have to start. I give my caveat. You're asking a bond person about equity, so it's always like a
Fair enough.
dangerous place to be in. But I'll give you my sort of like macro view, and just everyone has to remember that I'm not an equity strategist, and I don't have a price target for Nvidia, as much as I know that's like really what everyone wants to hear. It's always disappointing when people are like, "Man, she's going to talk about interest rates instead of like, where Nvidia and Microsoft prices are going." But I just have to say that. Yeah, I think it's really interesting. And again, like from my macro lens, one of the questions that I always get is like, we started this conversation like talking about, disruption, and there's risks around inflation and the labor market slowing, and there's geopolitical risks out there, and like all of these different things. And then you kind of look at your screens and you're like, man, but the equity markets performed, really, really well, despite, a lot of the scary things that we talked about. And I think that goes back to my last comment of, there can be sort of, hard, bad things happening. There could be scary headlines, but that doesn't necessarily mean like, we should be panicked and not be invested, or sort of be hiding out in T-bills and all of that. And I give this sort of, sort of long diatribe to, in not answering your question, because I do think it's important context to remember that when we look at S&P and we think in our brains that we're used to S&P being like, 500 large companies and, sort of a very diversified index, that it's really become a lot less diversified. And you kind of have the 493 versus the 7 that you highlighted. And so I think that's just really important for people to keep in mind, is that the signal from S&P 500 is not necessarily a great signal about like what's happening in the economy, and it's not necessarily a great signal about what's happening with other companies. And so I think this is important. We can talk about like from a portfolio perspective, it's important to remember from like a diversification perspective that maybe you're not quite as diversified as you would have thought if you're invested in S&P 500. And I think it's really important from an economic perspective. We talked about AI investment. The numbers that Microsoft and Meta put out last week in terms of how much investment they're putting into the country in AI related things is so big. We're seeing it in the GDP data. These 2, 3, 5 companies doing this stuff is so big that it's impacting the overall economy. But I think that the important macro thing for me as well from this is, those 7 companies are not very big employers. They're not a very big percentage of the overall economy. And what's happening on Main Street, what's happening with small businesses and mid-sized businesses actually tend to be what drive the labor market. That tends to be what matters more for interest rates. So I do think I think it's important. I think it's great that we're getting AI investment. It's great that we could have, sort of higher productivity and more investment in the country and all of those things. But I do think we have to remember from a portfolio perspective that, we don't necessarily want to only be exposed to 7 companies. And from a macro perspective, there's a lot more that matters for hiring and inflation and all of these things beyond what happens with these companies. So I think I successfully dodged your question on S&P leadership because it's not my area of expertise, but that's how I think about the implications of this from a more macro lens.
All right, Allie, we're going to get to bonds now. So we'll get to your favorite place.
Yeah.
And really, I think it's important for investors to know because everybody always tends to want to talk about the stocks. They want to talk about what went up the most, and that's the thing that maybe you talk with your friends about at the cocktail party. I bought Nvidia when it was down, and it's up huge now. But there are so many things, and you somewhat alluded to this earlier. There are so many things that are levered to the bond market, and it is such an important component to the overall economy, and not just the government spending, but also to corporate spending as well as the financing mechanism that's there is hugely important. So I think it's very good that we talk about bonds. So we've talked about the prospects of the Fed cutting rates. Now, let's maybe just talk about what the impact on bond investors would be if, in fact, we start to see rate cuts maybe happening as soon as September. What would that mean for the bond market? Where are some areas that you see opportunity if, in fact, the Fed starts to cut rates?
Yeah, I want to just echo your comment. I know it's like more fun to talk about Nvidia and like meme stocks and other topics, but from a macro perspective, again, in terms of what drives economic growth, interest rates are so important. The financing you talked about, whether it's the debt that someone takes out as a mortgage, that's part of the fixed income universe. Whether it's a country financing their military or their spending, or whether it's a company, large or small, sort of funding their business activity. All this is happening in the bond market. And so when we think about how asset prices and how markets actually impact GDP growth, that's one of the things that does matter. We actually tend to focus more on fixed income because it actually tends to be sort of more important to what happens in the economy. So just a plug there on fixed income, since you mentioned it. In terms of the outlook, I think that the main message that we want to send in terms of the opportunity in fixed income and in bonds right now, is actually a really simple one. It was a challenging year for fixed income back in 2022. We saw one of the fastest Fed interest rate hiking cycles that we've seen in decades. But what that means today is that interest rates are quite high, really across different products. And so while you have this more complicated question around like what's going to happen with AI and equities and geopolitics and all of these, sort of, more complicated, difficult questions that we've been dealing with so far, I think in fixed income, it's a little bit simpler. Yields are high. Your starting yield tends to be sort of the strongest indicator of returns on average over time. And so if you can invest in sort of intermediate, high quality, liquid fixed income, starting yields are high now. You don't have to take on a ton of credit risk. You don't have to be way out on the long end of the yield curve, worried about fiscal problems or what have you. And you can still have a portfolio that has a pretty high yield. And so I think that is really the message for us is sort of like, keep it simple, high quality fixed income and sort of the intermediate part of the yield curve. So we mean like, call it 3 to 7 year or 5 to 10 year type bonds. Looks really attractive to us. Municipal bonds, we can talk about munis as well. I also think are really interesting. There's been a lot going on in muni markets. That's another high quality, sort of exciting part of the fixed income universe. So even though I just said lots of, sort of again, like scary things, changes, lots of headlines, lots of complication, I think in some ways the fact that starting yields are so much higher in fixed income now than they were, 5 years ago, 10 years ago, just makes the investment opportunity almost simpler.
Yeah, why don't we talk about municipal bonds? And I think that's a great place to bring up because, if you look and you talked about 2022, rough year for bonds, but then, had better year 23 and then 24, 25 so far have been pretty good years. The good old 60-40 portfolio, 60% stock, 40% bonds. The bonds have actually been contributors to overall performance over the last couple of years. However, municipal bonds have really struggled for some reason, and I'd be curious to get your thoughts on why the muni market has been struggling relative to corporate or government bonds, and then maybe again what your outlook is in that space.
Yeah, yeah. So munis can be a little bit special in that they tend to be a little bit more sensitive to like investor sentiment and flows. So if you think about like the treasury market or corporate bonds or pick your other favorite global bond universe, they tend to be sort of have like a larger institutional investor base. So companies, like, firms like PIMCO going out and buy and acting in these markets on behalf of our clients. Of course, we also have a large municipal bonds team, but munis tend to be pretty sensitive to like broader investor sentiment. They tend to be pretty sensitive to individual investors, decisions, whether that's a tax policy change that has caused them to, sort of reevaluate what's going on, or just shifts in sentiment and those kinds of things. So you get this volatility in munis. You get this sort of like, temporary periods where you're like, why are munis not performing as well as government or corporate bonds? And I think that tends to be some of it. But if we sort of, zoom out and and I guess I should mention as well, I mean, there have been some sort of political noises around some of the muni issuers as well. We talked about the certainty around tax rates with OB3. We also got certainty that the muni tax exemption is here to stay. So that was good news for the muni market. There's been a lot of headlines around, the universities who tend to issue in muni markets. So there's been some sort of more micro issues as well. But I think overall, when I think about the case for munis, yields are much higher, but quality has also gone up a lot too. So if you think back to pre-pandemic, it was like every week there was an article in the Wall Street Journal about like some pension system having problems, or the state of so and so was having, had too much debt and not enough assets. Munis have performed, munis as in state and local governments, credit quality has really improved over the last few years in aggregate. States got a lot of support during the pandemic, so rainy day funds and those kinds of things are in good shape. We've seen pension systems look better funded. A lot of the problems that sort of seem to be sort of plaguing state and local governments after the global financial crisis have actually resolved themselves. So you have this asset class that, to your point, like has underperformed a little bit. So yields are still pretty high. At the same time, the credit quality has actually, in aggregate across the universe, gotten better. And so I think that's a really exciting and sort of attractive opportunity for us. Um, you know, there's different points on the curve that are more appropriate for different investors or what have you. But I think high quality munis in aggregate, look like a really interesting investment opportunity to us as well.
If for anybody who's listening right now who's saying, okay, what in the heck are they talking about? I'm not really familiar with
Sorry.
municipal. No. That's I just want to kind of clarify that for folks. So, we're talking about municipal bonds from not only state but then local municipalities. But the attractive part of this in a taxable account is that these are in general federally tax free. So if you're in a higher tax bracket, all things being equal, if you, on a tax equivalent basis, you're getting more money in your pocket after not paying the taxes than you would by paying the taxes on a taxable bond, munis can be a great fit for some investors. And Allie, maybe talk about some of you talked about, since they've underperformed, that yield opportunity that exists. Maybe kind of quantify that for us to some extent.
Yeah. So again, I'm not the muni bond expert, so I have to caveat. But yeah, I mean, you think about, a 10-year treasury note that's still, call it around, 4.2% today. You think about, you can add on maybe a little bit of sort of higher risk credit above that in sort of a taxable account. You can talk about yields that are in the 5, 6, 7% type of range. On a tax equivalent basis, we're seeing some opportunities in muni space that are, quite high quality issuers. Where sort of tax equivalent yields are sort of adjusting the yield for that sort of tax advantage that you talked about, that are in that range or even a little bit higher. So I think it's, sort of a, again, it sort of depends on, individual, tax rates and all of those things. But I think pretty interesting. And again, going back to some of sort of like the scarier stuff that we were talking about earlier, this idea that you can have a portfolio that has a relatively attractive yield, especially relative to where we've been over the last 10 years, while remaining relatively defensive, high quality, more liquid types of assets as well.
That's great. So, Allie, I appreciate you answering all of my questions. I think now we'll open it up for questions from the folks who are listening in. And just as a reminder, if you came in late, the way you ask a question is to email that. You email it to cornerstonewm@lpl.com. That will come to me. I'll ask the question on your behalf. I already do have one here from Robert. And I think this goes back to what we were talking about before about the debt and deficits, and you made the comment that everybody already kind of knows that it's there. It's not like this is a big secret. We know there's debt and deficit, but yet the market seems to still be functioning. Credit markets are functioning just fine. Robert's question is, will future interest rates be forced to increase because of the huge amount of debt that has to be financed?
Yeah, it's a great question. I think the very short answer is probably yes. Not necessarily next week or next month or next year, but over time. PIMCO, we come out with a 5-year view every year. We stop thinking about what's going to impact markets tomorrow, and we think about really long-term issues and publish something for our clients. You can find it on our website, where we think about sort of really long-term issues, so 5 years plus. And one of the views that we've had over the last, sort of several years when we published that 5-year outlook is exactly this. It's this view that over a very long time horizon, we think that the U.S. interest rate curve should be steeper. So what we mean by that is we think that if you're going to lend, over a longer time period, so even further into the future when this fiscal situation is unknown, when debt to GDP could be rising, so think like 20 or 30-year government bonds. We think that investors should get paid a little bit more yield to own those securities because of some of this uncertainty, because of the fact that we think that debt to GDP could continue to go up. But that's sort of a long run issue for us. I think what I was talking about was more of this idea that, in the short run, if the Fed's cutting, if rates are relatively high, if you sort of stick to not quite as long dated maturities, we think it's a pretty attractive opportunity in fixed income. We think yields can probably drift a little bit lower from here. But I do think that, again, in aggregate, much higher government debt to GDP should be associated with somewhat higher interest rates. So I think that is something that, that we're sort of positioned for in our portfolio, this idea that interest rate curves could be a little bit steeper over time because of some of these issues.
So, Allie, I'll ask you one last question. And I alluded to earlier the 60/40 portfolio, and that's kind of long been thought of. Okay, this is the balanced portfolio, 60% stocks, 40% bonds. And because bonds had a challenging year back in 2022, and really didn't provide maybe that ballast that everybody thought in the portfolio, you're now hearing a lot of talk of, well, the 60/40 has to change, it needs to be 60/20/20, whatever the mix might be. And just by the way, for everybody listening, everybody on the call has a different risk tolerance. I'm using 60-40 as a proxy. Your mix might be 80-20, 70-30, 50-50. It's really what's most appropriate based on the discussion you have with your financial advisor. But let's kind of stick with that 60-40. What are PIMCO's thoughts on portfolio positioning? Does that still make sense that the bonds are the ballast in your portfolio, or are there other things that investors should be thinking outside of that traditional mix?
Yeah. So the joke for us, because we're fixed income managers, is actually that, it's 60-40, but it's backwards. It's now, more fixed income and less equity. And I know I sound a little bit biased saying that, but I think sort of there's sort of 2 points that I would make around that. So the first was your comment around like this idea of like bonds as a ballast and bonds as a diversifier. What we've seen is that as inflation has come down, it's not as high as it was during the pandemic, of course. That those typical diversification benefits that you get from bonds, where when bad things happen and equities don't do well, bonds perform well. We've seen it come back. So we've seen like when there's been sort of like scary bad things happening, we've seen that typical sort of negative correlation. We've seen bonds perform well. So again, so like, it's such a recent example, but on Friday, we got like sort of scarier, worse economic data. The jobs report was softer, and boom, you saw that sort of typical flight to quality, as we call it, where bonds perform. So we do still think that the diversification benefit is there in bonds. We think that, really when you've seen bonds not work well, has been in very high inflation regimes. We don't think we're sort of back where we were in the pandemic, where inflation was almost 10%. That was like a once in a, sort of 100+ years bad sort of experience for bonds. I think the other thing when I was sort of joking around, flip your 60-40, going back to the discussion we had around equities, I think the other thing that's really different right now is what we call like valuation. So how expensive is the price of something today relative to, pick, sort of a longer trading history. So if you look at equity markets, pick your favorite metric, they look pretty expensive. And that doesn't mean that, AI can't keep powering equity markets higher. That doesn't mean that, everything has to come crashing down, but they look pretty expensive. And starting valuations do over time, on average, tend to be good predictors of where things go. And it's totally the opposite in fixed income because of the reset in yield, because of that painful 2020. Valuations in fixed income still look really attractive. And bond starting yields look really attractive to where they have been relative to the last, call it post GFC period, so more than 10 years at this point. So just a pretty different, sort of starting point in terms of starting valuations. And that's why I made that joke. So diversification benefits we still think are there. Starting valuations look really attractive in sort of core fixed income assets, munis, government bonds. Pick your favorite type of fixed income, and they look really stretched. Things look expensive in other risk assets. So that's why sort of that's why I made that joke. So sort of course, we're PIMCO. We sort of think these things, but I think there's strong data to suggest that there's still a role for bonds in people's portfolios.
Well, Allie, if we do this again in 8 months from now, I hope we don't have as many things to talk about, that we've had in the first 8 months of the year. Hopefully things are a little bit more calm along the way, but we'll see. But I can't thank you enough for joining us today. Really appreciate you taking the time to answer questions for our clients, and hope to have you back sometime soon.
Yeah, thank you again so much, Bill, for the partnership, and everyone for the time in August. We really appreciate it.
Thanks a lot, Allie. Have a great night.
Thanks, everyone.
Bye, everybody.